According to CNBC, stocks fell Wednesday as investors digested a summary of the Federal Reserve's July meeting, which hinted at potentially higher rates. Unfortunately, that doesn't square with what you see if you look. Now, they must have done this right after the Fed minutes came out, and I understand how this can happen. You say something, and 10 minutes later, it's all changed. On the other side of the coin, what actually happened is the stock market has gone up after being way off this morning. It continues to be down off of its highs, except last time I checked, the Dow was slightly up after the Fed minutes came out. So what did they say? Well, they said with inflation still well within the committee's longer run goal and the labor market remaining tight, most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. In other words, exactly what they've been saying all along. So, and this is, of course, about 3 weeks ago that they did all this. So then they said a little bit more here. Oh, whoops, I thought there was more. I am so sorry. I guess there isn't. Oh, no, here we oh, that's what they said. All right. So not really nothing there. So we're stuck with what we've had all along. So what I wanted to do this morning, this is Randy Kirk. If you like, hit like, subscribe, notify. We are not going to have Brian Wang on today. That'll be at the earliest tomorrow and could be Friday. And we're pushing back that entire China thing by a day or two, but it's still going to happen. Just, schedules get all messed up and we just couldn't pull it together. So what I'm going to do instead is I want to talk about this inflation thing in a little more detail because this is what has got the market stuck right now. If this is helpful to you, if you learn anything from this channel and you think it's worth $5 a month, can I encourage you to go up on Patreon and sign up? There's lots of goodies on Patreon. When you go there, you can, buy a book, get a book for free if you join at the $5 level, and 2 books for free. These are audio books. You get 2 books for free if you join at the $10 level. All right, let's dig into this a little more deeply. What I want to do right now is I'm going to take you over to, of course, what you're so used to with me. I love Trueflation. And so I'm going to share my screen. That'll just take a second because I'm starting to almost get to where I know how to do it. Not necessarily really well, but I'm getting better and better at it all the time. So let's share the screen. And here we go. And let's get the screen up that I want to see. All right, here we go. I'm hoping that you can see the screen. You should be able to see this now. All right, so Trueflation, here's where we are right now. We're at 2.42. So this is year over year. This is what they're showing given the entire range of items, and it is exactly right now. What I want you to first of all pay attention to is down here. I want you to look at where we have now been since June. You'll notice that in June, we were at 2.42. We're now at 2.42. So we've gone now June, July, August. We've gone almost 2 full months at 2.42. It's gone up a little, down a little, up a little, down a little, but we've been very, very solidly now for 2 full months at 2.42. What does that mean? Typically, what this means, Trueflation has found, other people have found, that 2 months later, the CPI catches up. So in the next CPI print, we should be seeing this. We might be seeing it with the PCE print next week. We might be able to see that coming down as well. But it looks like we're at about 2.4 right now. So this is really, really good news. And this is what I would think the Fed would be paying attention to, but they are obviously going to wait for these other reports to come out. Now, what Trueflation does is they divide it into categories. And I think this is very, very helpful to look at. I'm hoping this will be interesting to you. If not, well, I'm sorry, but I think if you use this Trueflation thing, it will help you to have information that I think a lot of the major players may not be looking at, and this gives you an advantage. So let's start with food and beverages. Food and beverages, you can see right now, are down. They're down versus last month. They're down versus the quarter. So let's take a look down here at the overall picture. And you can see the blue line is showing that food and beverages down 0.01 year over year. That's the year over year number. You can see that is pretty much the lowest point it's been. It's just continuing down. So food and beverages, which makes up, let's take a look down here. You can see right here. See, it makes up 15.3 of the total CPI, 15.3 of the headline CPI, not the base case or the core case, but the headline case. So 15.3. So it's a major category. And you can see that clearly it doesn't appear to be in any danger. In fact, the trends all seem to be going down. It divides it into two categories: food and non-alcoholic beverages, and food at home, food away from home. I'm sorry. So you can see all three of them are headed down. So, all right, let's go next. Let's go to housing, which is a major category. You can see housing is up 1 point versus yesterday, 1 point, this is year over year, and 0.17 over last month. It is still up a little bit versus last quarter, down. Now let's look what's going on. Well, okay, this is rents down here. You can see rents year over year are at 0.24. So they're not up. They're basically flatlining compared to last year. And this has been true for a long time. You can go back here into June and see it was 0.59. So it was, basically a half a point even back then. You can look at housing, the purchased housing, owned dwellings is up 4.66, but it was only up 3.07 until some new reporting came out. I have been telling you for months that purchased homes, the prices are going to go up. It is the season, and there's not any inventory. It is the worst inventory situation probably in history. Certainly in recent history, in modern history, it's never been this low in terms of inventory. And there are some people that are just going to buy anyway. And by the way, 7% interest rates, that's not that abnormal. 6%, 5.5%, 6, 6.5%. This is not abnormal. Plus, smart investors, people that are smart, that are buying homes right now, know that if the interest rates do go down, well, first of all, if they don't go down, well, you're going to have to buy sometime. If they do go down, you can refinance. If they drop by even a half a point, you can refinance. So no, people are still going to buy the housing. And since there's no inventory, people are going to have to buy, pay the higher price. All right. So then we get into, by the way, and housing makes up 23.2. It is by far the highest, the biggest category. And so therefore it affected that overall number that we looked at a few minutes ago up here. You notice bouncing up right there. All right. Okay, now let's go into transport, which is another large category. That is up a little bit versus yesterday, a little bit more versus a week ago. But even versus last month, it's up 3%. But that's a month over, a quarter over quarter. But when you look over, month over month, it's up 3%. But if you look at last quarter, it's still down. And in fact, if you look down here, the total is now only 1.27 transport total year over year. It's up now because why? Because of gasoline. Here's gasoline and other, all kinds of diesel, all those kind of categories. It's gone up rapidly over the last month and a half. Why has it gone up rapidly over the last month and a half? Because oil has gone up from 67 to 82. So that is now, working its way through the system. But if you look at vehicle purchases, net outlay is down 3.44. So that is balancing this to give this total of 1.27. You see how you can use this to really, really get an understanding. I expect this now to flatten out. I don't think it's going to go any higher, or at least much higher, because of a number of reasons. People are worried about China, so they think that China won't be using as much oil, so that's taking some of the demand away. And then, of course, the Saudis want to keep it at this level. I think it might settle around this $80 level. It's been down the last day or so. All right, let's go. And then oil, how much is oil? That's another 20%er. Okay, oil in cars, trucks, etc. Transport makes up 20%. Okay, so that's an important category. So housing and transport that make up two of the biggest categories, both slightly elevated the last couple of weeks, but they should not be running away, okay? That's the key. And in fact, they still are only at, as you can see, the overall transportation at barely 1.27 year over year. And we looked at housing, also wasn't up year over year that much. Now, if we go into some of the smaller categories, you can go into utilities. Utilities is doing great. It's down around 2% year over year, headed down, been down, headed down. Oil might start to affect it. Natural gas, though, is starting to fall back. It went up a teeny tiny bit. It's fallen back again. If we go in, so utilities looks like it's completely under control. Now let's go into, oh, by the way, what is utilities? Utilities makes up 6%, okay, a much less smaller group. Healthcare, which makes up another 8%, which is just slightly larger. Look at that. It's under zero, 8.87 year over year drop, okay? This is deflation, not even disinflation. This is deflation. Okay, now let's look at household and daily items. Now that's still rolling around at 6.36. This is not terribly surprising. This might be a continuation of some supply-demand imbalances. I would expect this number, you can see it was going down, then it had a little peak and then down. I think there might be still some imbalances, not 100% sure, but this number is not out of control, and it's only 7% of the total market, and it was headed down. Alcohol and tobacco, you can see, is also around the same category, right around 6. It's actually right now at under 6. It has been kind of steady Eddie all year around that level, and it's only 2%, 1.9% of the overall basket. Clothing is at 3.5, a little bit less, 3.27. Again, only 4%, less than 4% of the total business. Communications went up a lot and now has fallen back dramatically to where it is only 1% year over year over last year, and it's about 3% of the total basket. Education was going down, 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 down. It has popped up here, still only 3% year over year, and only makes up 2.33%. And finally, recreation and culture, it went up a lot because of a lot of hotel rates and airplane rates and whatnot were going crazy. Now that we're getting out of season, you see it's dropping off rapidly to where it's 4.56 year over year, only makes up a little less than 6% of the total business. And then others is running also around 6%, like we found with a number of categories, running around 5 or 6%. Total together, I think they make up about 15%, maybe 20% total of the basket of goods. All right, so that gives you that piece of information for looking at all of this. You can see down here, Truflation's correlation with the CPI is 0.97%, but it tends to run 2 months ahead, as it says here. A good proxy for where inflation is going in a couple of months, use Truflation. This is Raoul Pal, the founder and CEO of Real Vision, global macro investor. All right, so there's more to this site. You can look at commodities as well. I won't go into that right now, but this gives you an idea of where we really are. Yes, there are still some bugaboos in consumer products, some bugaboos in other, but they're small categories. The really big bugaboo, as the Fed has been talking about all along, has been the cost of housing. That is definitely modifying, and I think will be fine. Looks like it'll be fine. And then the Fed is worried about labor, but there hasn't been a single labor report with wages over 4% year over year. So I don't think wages are going to be the issue. I think we'll see, as you know, I'm a big productivity buff. Productivity is going to be the big issue going forward. Pay attention to productivity. As productivity goes up, wages will modify. Wages will not need to go up as much. If the market, depending on how strong the market is, we'll be talking tonight about the rest of the market in my regular Wednesday night show when we look at the entire picture. But if you look at the entire picture, it looks to me like labor is not going to be the issue this particular year. What we got here is the Dow is slipping back down a little bit. Yeah, everything is slipping back down a little bit. So it's kind of sideways. I would say right now, the reception to the Fed minutes has been sideways, but it has not been it certainly didn't create a pop, didn't change the narrative at all. And so we're still stuck in the issues that we talked about this morning, but we'll talk about in much greater detail tonight. So I hope this has been useful. Hit like, hit notify, hit all that stuff. Again, tonight I'll be doing my regular Wednesday night overall financial picture. Tomorrow morning, we'll take a look at the normal morning show, and then maybe we'll have Brian on tomorrow talking on that Asia issue I've been mentioning to you. And then please join Patreon. Get yourself a free audiobook. Really, those books, you're going to learn a lot. Okay. All right. Let me stop sharing and let me just say that it has been wonderful, as always, speaking with you today.